Phil Palumbo joins us here. Hey, Phil, I guess the Federal Reserve, I guess some of these other central banks kind of did the markets a solid this week, saying, hey, we're still kind of in that dovish camp. Is that your read?
Yes, so they were dovish in December. I was a little surprised that they weren't a little bit hawkish this time around, just because it seems like on the service side of inflation, there seems to be some stickiness there. But overall, I think what the Fed did was the right thing. When you think about inflation, specifically on the good side, you're seeing deflation. You're seeing inflation being sticky and persistent more on the services side, but that's more on the experiences side of things, local restaurants, hotels. And I think the Fed made the right call, and they understand that, and that's why they're saying they're going to put together for us three cuts this year.
So, we're already looking ahead to the rest of the year. We've been talking about our summer holidays already. And, what do you think is going to be the vibe in the U.S. for the end of the year? It looks like corporate earnings might be positive, but then maybe there's some election volatility.
Yeah, so we're long and strong in the markets, and we're buyers on pullback. In the very, very short term, I mean, the market probably is overbought here. But overall, when you think about this year, there are really three major things that are happening that are positive for equities. Number one, you have earnings that are going to accelerate, just like you talked about, versus 22 and 23. You're looking at a Fed that's going to be cutting rates three times. He's telling us what he's going to do. And then you have an election year. And typically an election year is very good for the market and the economy overall. And then you have artificial intelligence, which is really moving us into an economy that's going to increase productivity ultimately. So investors are getting ahead of that. So those are really good reasons, why you want to be involved in equities this year.
All right. So, Phil, on the equity front here, I see kind of one of the sectors you guys like here, utilities. Give us the utility call and what, again, you were suggesting could be a declining rate environment.
So utilities historically been an interest rate sector, and obviously they've come down relative to other sectors because of interest rates. Now, when you think about utilities going forward specifically, electricity demand is only going to increase over the next 3 to 5 years. So when you think about utilities today, where they're trading on a fair market value basis, they're trading about 15% below fair market value. The P is around 15 and a half, dividends attractive, and they're off its high because interest rates up. But this year, if the Fed is seriously going to cut, that's going to be favorable to utilities. Plus, I do believe there is this growth story, like I just said. Electricity demand up 2 to 3 times the next 4 to 5 years is going to bode well for utilities.
One of the things on utilities that I've never gotten comfortable with, but I guess if you're an utility investor, you got to be comfortable with it, is just kind of the regulatory environment. Where are we in that front?
Yeah, no, I agree with that. I mean, that's something that you have to watch very closely, and that is a risk, somewhat of a risk in owning utilities. But at the end of the day, they made investments in renewable energy, and as they start to use more and more renewable energy, which is happening, that's going to increase their margins. So you think about, again, electricity demand is going to create growth of about 6 to 7%, which is most estimates going out to 2028. So you combine the renewable energy investments that they've made, increase of margins as a result of that, the demand coming in. I think regulators understand all this, and they'll be on the utility sides. And again, for those reasons, I think you can see a really nice rally from here specifically over the next 2 to 3 years.
And some of the energy companies, Alex Steele, my co-host here, she was down in Houston this week at an energy conference, and the energy companies were saying, we're an AI play because all these large language models are running on these big data centers, and you know what the big data centers need? Energy, and lots of it. So maybe there's a little AI play there. I don't know.
Yeah, I mean, we're never short of talk about
Yes.
a company being an AI play. But let me shift gears a little bit, because what I would very much like to understand is your take on the U.S. consumer, because we were talking earlier on the show here about how strong the U.S. job market is. But we get that inflation's coming down, but prices are really still awfully, awfully high. So what's going to be the spending power looking like going into the end of the year?
Yeah, so we're anticipating spending to slow on the back half of this year, mainly as the excess savings from COVID will start to dissipate. So for those reasons, we could see the consumer slowing and ultimately the economy slowing, not to recessionary zone, but ultimately slowing because of the excess savings that I just talked about. Now, we are seeing some weakness in the consumer on the credit card side, which continues to move up parabolically, and we're seeing consumers now borrow from their 401ks to spend. So it seems like people just been hurt so badly by COVID, not being able to do anything. And I still think there and believe, truly, truly believe there are these after effects of COVID that's causing people to enjoy experiences that they couldn't do before. And they're willing to do whatever it takes. And I think they have confidence that they'll borrow from their 401k. They'll pay on credit cards because they still have jobs. As long as they have jobs, in their mind, they can pay for these debts, and the party will continue going until one day it won't.
Hey, Phil, one sector of my career I've stayed away from desperately is biotech because I don't have a PhD in biomolecular engineering. I don't have an MD. How do you guys get comfortable with biotech?
Yeah, so we did something really interesting as a firm. So we developed what's called an emergent growth strategy, which we strategically partnered with a biotech hedge fund manager, and we came to
Ah,
agreements of utilizing his long only ideas in his hedge fund. He's got a track record going back to March 16. He's got the background that you need, Paul, to be in the sector.
smart.
For us, the biotech sector, as we know, is down because interest rates up. Another story around rates, and it's a very capital intensive business. But now that rates again will normalize or stabilize rather, and maybe even come downward, I think you're going to start to see capital being pushed into the biotech area. And again, artificial intelligence is going to be a really big part of that. But biotech, which would be positive for getting more drugs approved. So I think you could see some really good upside in the biotech sector if you're in the right businesses.
One issue that's been really keeping everyone here at Bloomberg News and Stories is commercial real estate. And I wonder if you are getting comfortable with that at all, if you feel like we've hit a bottom with all the difficulties in that sector.
Yes. So as an investor, right, I'm more value oriented. I want to know where the trouble is on the street in various markets. And we know there's blood on the street in the commercial real estate market for obvious reasons. And for those reasons, with fresh capital, now is a good time to start tiptoeing into commercial real estate and look for opportunities because there are many owners of real estate that are selling at fire sales because they can't afford their new mortgage rates that are up 2 or 3 times. So we know that there's pressure there. And if there's pressure there, and if you're a buyer with fresh capital, you're going to get good deals. But you have to be a long-term investor. You can't just say, I'm investing today. In the next 6 months, I'm going to make a fortune. It's going to take 3 to 4 years to really make a good return on your investing capital. But at least you know that you're getting in at favorable prices.
Phil, thanks so much for joining us. Always appreciate getting your thoughts.